Okay, welcome. It's good to have you folks here today. We're going to be talking about commercial properties and give you a bit of an introduction to some of the strategies that we'll be talking about as we go through the webinar series on commercial properties. As always, when we begin talking about putting together a strategy, we want to encourage you to round out your team. And there are some people that you will have on your team that will always be there no matter what strategies you use. But always when you start to introduce a new strategy, like say commercial in this example, there might be people that you need to get on your team that you didn't have with other strategies. So for example, with a real estate agent, you want to make sure that the real estate agent that you're working with in commercial is somebody who specializes in commercial. You're going to need a commercial lender. You're going to need an attorney that understands the ins and outs of commercial investing. And so this is going to change up some of your dream team a little bit. You'll be adding to whatever else you've been doing and pulling in some people that can work specifically with commercial. Okay, so just keep that in mind. And you want to have a lot of this in place before you actually start looking at doing deals, because they're going to be part of your process in making things work well. So again, this is just kind of the way that we present all of our success series. Is we're going to give you just a brief overview of what we're going to cover in the 6-week series, give you a little bit of an inside look into the different things that we'll be talking about each week. But we also want to include what we call today's takeaway, which is something that you can be able to use today that you might be able to either explore doing commercial properties with, or maybe even start to begin doing some of the work that could put that together for you. So just be aware of that, and encourage you to stick around if this looks like something that would be worthwhile to you, and I hope that you'll be able to take things home today that will benefit you in some way. So the things that we're going to be covering in the commercial series are going to be things like the benefits and risks of commercial properties, a little bit different than what you might see in just regular investing in residential properties, and how to find those properties, the types of commercial properties, lots of different ways to invest in commercial, how to analyze the properties to see if you're going to be getting a good deal or not, the property management aspects, which would include things like inspections, repairs, and maintenance. We'll also be looking at negotiations and how that works out, how you put things in writing, contracts, making offers. We want to talk about how you add value to the deal. And so you do that by process of lowering expenses, increasing income, etc. And so we want to talk about those kind of things, as well as tax management, working with different ways that you can either save money or create shelter with your taxes, or at least a deferment that will increase your bottom line as things go. So this is kind of the set of things that we'll be talking about in the first set, basic commercial course that we'll be putting together. There's an advanced course that goes beyond this, and each one of these different strategies, each one of these different markets, if you will have their own set of presentations that we'll do. There's going to be a little bit different way to look at wholesaling when you look at commercial properties. The basics are the same, but some of the details are going to shift up a little bit. Same thing with working with foreclosures. So there's a way to work with foreclosures with the single-family residence, and a little bit different working with foreclosures if you're talking about multifamily or commercial properties. We'll be talking about how to work with a triple net lease. What does that mean, and how does that become profitable? Land banking, storage units, mobile home parks, condo conversions, and funding. Where does the money come from to do these deals? So those are all a second series. We're not going to really get into any detail with these particular topics tonight, but we'll be just going over the basic series and giving you some insight into what that's going to be about. And then if you find that some of these other things are intriguing, then we'll get you set up with some of those as well. Christine, did you have anything you wanted to add?
Nope, that's great. You're doing wonderful. Just keep going.
All right. So in the first week we start talking about commercial, we want to introduce you to some of the benefits and some of the risks that go along with investing in commercial property. So one of the benefits is that you get a better return on your investment with commercial. And with commercial, just kind of on average in the industry, you can expect somewhere around 8 to 10%, possibly even 12% return, which is several times higher than what you might see in a residential as far as direct ROI. So just on the whole, commercial properties tend to do better as far as return on investment goes. You also get to work with what we call economies of scale, and that is when it's basically the idea of buying in bulk. So, if you go to Costco or some similar type of store, you can buy things in bulk and get discounts on them. Well, the same thing is true for supplies, for paint, for um, services that you might need to have rendered. When you have lots of properties to work with, those things can get done at a greater discount if you can do it with a lot of things instead of just one at a time. It also allows you to level out the downside of vacancy rates. So if I have a fourplex and one of my units sits empty, and then I'm only getting 75% of my income. If I have 100 units and one of them sits empty, I'm still at 99% occupancy. So it just kind of levels out things a little bit for you. If I have just a single family residence and it sits empty, then I got nothing, I got zero. So there are some advantages to working with more units. The more units you have, the more you can take advantage of economies of scale and leveling out your vacancy rates. It's going to allow you to work with professional relationships. Now, when you work with single family residences, sometimes you run into some people that don't have very much experience in real estate. And you kind of have to work with sometimes the ignorance that you're going to get hit with in some of these deals. And that includes some of the so-called professionals that you may be working with. You'll have some real estate agents that don't have any experience whatsoever in working with investment properties that will hit you with all kinds of stuff that may not necessarily be true and could be at a disadvantage to you. Whereas if you're working with a professional that understands investing, then you don't run into those issues. Well, when you work with commercial properties, typically you're going to have a much higher percentage of people that have been in the business for a while and have some experience, at least some training and some understanding about this kind of investment. So you're going to have more professionals to work with than you would just if you're doing regular single-family residences. And the financing is different. The financing industry for commercial properties is not really regulated the way single-family residence would be, or the way residential property is. And that opens some doors. It also creates some risk. So just so that you're aware of that. In some ways, it's easier to get the loans, but in other ways, it's also creates additional risk. Some of the risks that you'll be looking at is that if you wanted to sell the property, it takes a little bit longer. It's a slower turnover time. Inspection times last longer. Financing sometimes takes longer. Getting somebody who might be interested in a property that may cost multi-millions of dollars takes longer. And so it's not as liquid as working with a single-family residence or even with 100 single-family residences. 100 single-family residences would be a lot more liquid than a 100-unit apartment building, for example. So it turns around slower. You'll have some bigger upfront costs. So if you don't have resources to work with, you're going to need to partner up with someone who does, because there's going to be some upfront costs that you're going to have to deal with that you wouldn't necessarily have to face with a single-family investment. There's going to be potentially more liability, a little more risk. You can protect yourself from that, but understand that it's still there. And it's going to require the use of professional services in order to do this job very well. So property management, for example, would be one area where you'd be looking at some professional services that you might be able to skate by without if you're just renting a house, for example. So those are some thoughts on some of the benefits and some of the risks. Christine, do you have some thoughts on that?
Probably just a confirmation that everything you're saying about increased risk, but also the increased potential. It's really true. Commercial is really an animal unto itself. Some things are kind of similar to residential. The process, like Steve's talking about, as far as getting financing, finding good deals, analyzing things, a lot of the mechanics are the same, but you're dealing with oftentimes a lot more zeros at the end. So that alone brings some increased liability. But when you get to the point where you're ready for commercial, there are certain commercial properties that are a little easier to bite off at the beginning instead of some of these really, really big ones. So I would recommend, because there are so many different types of commercial properties and so many varying degrees of risk, that you just really do your research ahead of time. It's different in the way that when you go into a neighborhood and there are a lot of houses around, the houses are pretty much the same. With commercial properties, you might have one that's completely different than everything else in town. There might be a few that are kind of the same, but they're all the way across town. So appraisals and valuing can be a little different. Whereas with a house, it's okay, this one's 275, this one's 280, this one's worth 290. They're all fairly similar in most neighborhoods. So getting the values right, figuring out your cash flow correctly, looking at the numbers on something that maybe you've never even done before, that's where Steve's talking about the professional services, where those things come in very, very handy. So that's really what was on my mind, Steve, but you covered it very well. Next slide.
Excellent. Thank you. All right. Some of the differences between residential multifamily versus commercial multifamily. So with a conventional residential multifamily property, that'd be a duplex, triplex, and fourplex. And what I mean by conventional is that's where you can just go to your regular old bank and get a loan, right? They'll fund you duplex, or triplex, or fourplex. However, if you go 5 units or above, that gets labeled now as commercial, whether it's a residential place or a factory. It's still commercial with 5 units and above. When you hit 5 units and above, then the financing becomes completely different. And so you need to be aware of that. If you want to stick with just regular bank financing, then you need to stay at fourplex as your biggest units. Okay? So just be aware of that. There's different kinds of commercial properties, like I mentioned. Some are higher risk than others. So we kind of listed out here. The ones that are higher risk because there's a lot of turnover and there's a lot of potential for the business not making it, right? So restaurants are fairly vulnerable, particularly vulnerable to things that go on in the world and in the economy. I remember years ago when we first went into the Gulf area in '92, the restaurant business was booming, and then all of a sudden the bottom dropped right out of it, and restaurants were closing left and right. And that was just because of world events. It wasn't because that the restaurant hadn't been doing well. It's just that people stopped going out to eat. And that happened in 2008 when the economy started to fall apart. There's just different things, mega events, I guess you could call them, that influence things like restaurants. Anything that's kind of a luxury type of thing, you're going to find that's a little bit higher risk. Convenience stores and gas stations tend to be at risk. Hotels, motels, RV parks, mobile home parks. You can see the hotels, RV parks, mobile home parks, those things are all about travel a lot, right? And so you're going to find that when travel gets curtailed, those are vulnerable to those kind of things. Warehouses and vacant land. These are all areas that are a little bit more at risk. The lower risk things are things like anchor stores, like a Walmart or a Target, Home Depot, Lowe's, Walgreens, and CVS. These are all prime properties. If you had a property that you could lease to any of these guys, you're doing real well. You can also get a property that is connected to an anchor store. So you might have a strip mall, say, by a Walmart or a Target, and because it has an anchor store nearby, what they mean by anchor store, this is one of the big stores that draws a lot of traffic. And so if I'm going to Walmart and I also need a book or a clock or makeup or something like that, and I want to get specialty items, when I pull into Walmart, I'm passing up stores that are like this, right? And so if I want a specialized clock and I want to find a clock shop, if it's sitting there next to Walmart, odds are pretty good I'm going to go into that one rather than try to find one somewhere else. So that's the point. There's an advantage to being in a strip mall with a big store by it. Okay, so lower risk. There are small local post offices that are a great investment. And these aren't going to be your big downtown ones, but most small towns have privately owned and leased properties that post office gets set up in. And they can either lease that out or they can actually run the post office there themselves. But just little towns like there's a really great little, actually it's almost like a log cabin in a place called Axtell, Utah. It's just a small square wood building. It's kind of cool looking, but that's privately owned, right? I have another good friend that owns one of these in Iowa. Been passed down from his grandparents, actually owned it initially, and it's still in the family. So it can be a great one, just the post office. So these are some of the deals that you could be looking at, and the takeaway for today is we're going to give you some resources for finding the properties. So these are two websites that you can check into. One is called LoopNet, the other is called CityFeet. You can both of those websites you can get information on properties for free. However, they're both sites that you can pay a premium for and get more information. So you can do basic searches and get basic information, but they have some listings that are premium listings that only people that can see them are the people that are paying for the premium. And part of the reason for that is that as a seller, if I want to sell my property and I only want to talk to really serious people, I want to talk to people that are paying for a subscription rather than just any Joe that comes along and wants to get the information for free, because the people that pay the premium are going to be more serious investors. So you can get started for free, and the people that are willing to open up to anyone and everyone, you'll see their stuff, and it's still a good percentage of things that you can see for free. If you want the whole story, then you pay, I don't know, it's something like $45 or something a month. CityFeet is another one that deals in commercial properties, and you can find information on both of those websites that will help you to locate great properties that are listed either by private individuals or through real estate agents. So they have both kinds of listings. If you go to the MLS, everything's listed by an agent. If you go to LoopNet or CityFeet, then you're going to find things that are also for sale from private owners. So you can always go to a commercial real estate agent and get everything that's listed in your area or in the area you want to invest in if you're going somewhere else. In these two, you'll get some of those these listings that are listed with real estate agents, but some of them you won't. Not all real estate agents advertise on these two websites, and not all private individuals do either, but these are two great sources that you can check stuff out on. Christine, did you want to add anything?
Nope, that's great. Good info. Thank you, Steve.
Okay. This is a screenshot from LoopNet of some of the different ways that you can search. So you can see here I've checked the multifamily box. I've put in a cap rate of 10%. It's only going to pull properties up for me that have a 10% cap rate or better. And so in that situation, I would be looking for something that would cash flow. And I can do all kinds of things to tweak this search. You can see some of them there, but I can set up the criteria. And then once I pull up that information, then I can actually have it sorted by, say, cap rate. I can start with the highest cap rate and work down. So it's pretty user-friendly, and you can zero in on some pretty good stuff without too many steps. So I'll just give you a little bit of a shot of what that would look like. Second week, we're going to be talking about figuring this stuff out and working by the numbers. So in step one, we're going to be looking at figuring out how to calculate the gross operating income. And then we'll be looking at the total expenses. If we have that information, the gross operating income, which is just all the income that you have coming in, and then all of the expenses, with the exception of we don't look at the mortgage, then you're going to be able to find out what the net operating income is. And that's a very important key number in figuring out whether or not your deal is a good deal. Once you get the net operating income, then you can take that number, the NOI, and divide it by whatever the purchase price is, and it's going to give you a cap rate. And a cap rate is a percentage of the return on your investment. So if I plug in a search, for example, on a property that has a 10% cap rate, then what I know is that I'm expecting a 10% return on my investment. Okay? And that's how the property should pan out. And that's one of the ways that we look at calculating this. So we'll go through these numbers in greater detail in the series, in the 6-part series, kind of show you how to calculate all those things and just how to get the numbers right. There are some advantages and disadvantages to whether your cap rate is high or low. Depends a lot on what kind of things you're looking for. So if you're looking to have a property that cash flows well, you want to be looking at cap rates that are at 8% or above. If you're looking for capital growth, that's your primary concern, and you may be looking for a tax shelter, then you may be looking for stuff that has a lower cap rate, and that'll work just fine. So you can actually have a loss on the income on a property that gives you a great tax loss, and you can write off the taxes, but at the same time the value of the property is increasing at leaps and bounds. And when you have that kind of scenario, then you get the advantages of the tax write-off. However, you're building lots of equity. And so a lot of professionals like doctors, dentists, whatever, use these kind of sheltered investments in order to shelter their income, if they have high incomes, from whatever work they do. And at the same time, build equity in properties that are going to increase in value exponentially. So it depends on what your strategy is, whether you're looking for the cash flow or whether you're looking for a tax shelter or just capital growth. And the reason why that's really important for you guys to understand is if you're going to be wholesaling stuff, you don't have to just worry about properties that are going to cash flow well. You can do well wholesaling a property that will just simply give great capital growth. Mm-hmm. And so it depends on the market you're in, what you decide to do with that. But there's opportunities everywhere in every environment, in every economy to wholesale commercial properties for a great profit. So the example on the right is I've got $1 million property, which is small for commercial property. So if I buy the $1 million property at a 6% cap rate and I resell it at a 5% cap rate, creates a $200,000 profit. Here's how that works. So at 6%, the return on that would be $60,000, right? And if I plug that $60,000 of the net operating income, and I use a 5% cap rate, I sell it at a 5% cap rate, that's going to equal a $1.2 million sales price. So I don't know if you catch all of that. It's not really that important at this point. I just want you to expose you to the idea that if I buy at a higher cap rate and I sell it at a lower cap rate, what that means is I'm selling it at a higher price. And it's just working those edges of the cap rates. They're going to help create a profit for somebody that wants to wholesale and can create a six-figure income just by a 1% difference in the cap rate. Christine?
You know, just the thought that I had is maybe the second part about tax shelters doesn't make a lot of sense to some of the audience right now. But if you think about investing for your lifetime, you guys can really plan that at some point in your life, you may need to take advantage of that instead of really worrying about how much cash flow is coming in. So you need safe places to put your money and shelter that money. And so depending on where you're at in your own life, that could be something that you need to pay attention to and switch strategies on later in life. But for right now, like Steve said, if you're wholesaling this, for example, to someone else, you need to know what their situation is and which strategy makes the most sense to them. But then when it's your turn, make sure it makes the most sense to you.
Yeah, exactly. We just kind of want to open your eyes a little bit to being able to make a good profit on any good deal that comes across your plate. And you may not have on your radar tax shelter properties, but other people do. So if you recognize that and you see that and you see there's an opportunity for that, that's something that you can grab and run with if you know how to do it. So we use cap rate in determining the value of properties, particularly rental properties. So in this case, we have the same examples we had earlier, gross operating income of $18,000. And the expenses came out to be $12,000, which is pretty high. That's about, what, 2/3, right? Usually they run closer to about 50%, but net operating income, $6,000. This is not going to be a great cash flow property if you have to finance it, but it doesn't mean there's not good advantages in it. If I take that net operating income and divide that by the purchase price, it gives me that cap rate. In this case, I've got a purchase price of $40,000. So the $6,000 in net operating income by $40,000 gives me a 15% cap rate. Okay? I'll just give you an example of that you can look at and work through later. Today's takeaway, I want to give you some tools to work with in order to start figuring some of these things out. So here are some websites that give you information on what market rents are. And you can figure out crime rates and get a little bit of information about a neighborhood, see how those things work out. And these are really great tools for you to start just doing some research on rental property in general. You could use these for commercial or for single family, but this is mostly about residential commercial, if you're looking at commercial stuff. But some really helpful tools there. What I have here is what's called an investment summary. It incorporates what's referred to as a pro forma. And pro forma basically is, in a perfect world, not perfect, but in a reasonably good scenario, here's how we would expect this property to perform. If everything was lined up the way it should be, this property could perform at this level. That's what pro forma means. The column on the far right is the pro forma column. And I'm not going to go into detail about explaining this whole thing, but what I really want you to catch on this is part of what people give you when you ask them for their financials. It's a very important thing to be able to look at what's going on in this property. So this has a breakdown of how many units there are and what the different types they are. So I've got 4 units that are 2 bedrooms and 1 bath, 4 that are 3 bedrooms, 1.5 bath, and 66 that are 3 bedrooms and 1.5 bath. And I'm not sure why they separated the 4 from the 66. There must be some difference. I don't see it on the sheet. It doesn't really matter. But I end up with 74 units. It's going to give me the square footage on average, and it's going to give me the total rent for that square footage. And so I've got $900 for the 4-bedroom, or I mean, sorry, the 4 2-bedroom, 1 bath, $1,250 for the other ones. And what it's going to show me here is here's the rent for the 1 unit, here's the rent for the monthly rent for all of the combined units there, and then the survey rent is really what they're looking at there. Is they've taken a survey of rents in the community, and this is kind of an average. So not necessarily what's gone on with this particular property, this is just the survey. And then on the far right, we've got what could happen in more ideal circumstances. So that breaks it down. Then it gives you a section of the income. It can show you what the income actuals are, annualized, and then pro forma. And the gross potential rents, it's going to give you on the bottom line is the total operating income. And then it's going to break down what the expenses are. And as you look at the expenses, you might be able to see places where you might be able to decrease the expenses. So if you compare the pro forma column, just give you a third column down, for example, when it talks about payroll, and they're paying $115,864 right now. Pro forma is they're going to cut that back to 81. So this is one of the illustrations, if you will, on how you can take a property that has a set expense and change that expense in order to make it more profitable. So they're cutting, what, $35,000 out of their expense of paying payroll. So on the other hand, they're going to pick up $29,000 on a management fee that they weren't paying. So they're just kind of shifting that actually to a managing company rather than paying out payroll probably for family members or something like that. Well, anyway, this gives you an idea. All total, they only decreased their expenses by about $10,000. But just wanted you to get a chance to look at one of those and kind of mess with it a little bit and see what you can make out of it. Christine, any thoughts about that?
Just a caution, if you guys are asking for financials from people, understand that they probably aren't going to share them with you until you make an offer. So that's not really something that people hand out right up front. But if you show yourself to be serious and you give them an offer and either have a pre-qualification letter or a proof of funds letter that verifies you're able to purchase the property, remember these are not the same as making an offer on a little house. They want to know that you're financially stable and able to purchase these properties. So when you're asking for their financials, don't expect them right away. So have your expectations realistic. And second of all, when you do get them, you know, this example gives you an idea of 1 year's actuals. So that first column underneath the header price where it says actuals, about a third of the way down the paper, that's really what you want to find out. It's nice to have projections. It's nice to see, like Steve walked you through, as far as where can we cut expenses, where might our expenses actually increase if they've been doing a lot of the maybe the property management themselves or something else by themselves, maybe the landscaping, and you don't want to do the landscaping, you're going to hire that out. So knowing for sure what your expenses are going to be is helpful. But if you take an average of their previous ownership for the last 2 years, that's a little bit more helpful. 3 years is excellent, but a lot of times you can't get 3 years of financials and actual expenses on the property. Get what you can, but always ask for 2 to 3 years, and then do an average so you have a realistic idea of what the property is performing at. Is it on the way up? Is it on the way down? Or does it just kind of go up and down all the time? So the longer history you can look at, the better off you're going to be assessing what your actual income has the potential to be. That's it. Back to you, Steve.
Yeah, just to add to what you just said, and then you made some really great points there. You never buy on a pro forma. You buy on the actual numbers. The pro forma just tells you what the upside potential might be. That might be an encouragement for you to do the deal, but it's not going to affect your pricing. Pricing is always about what is happening right now. And if it's on a downhill slide, you don't even want to take the average. You want to take what's happening today. And so you need to be a little bit careful with that. If it's going up, if it's improving, you can take the average and make your case based on the average on your pricing. Just be a little bit careful with that. And part of the process that we don't really cover here is some of your initial overtures to somebody that might be selling a commercial property would be to send them what's called a letter of intent, which basically you just outline what your purchase price is going to be and what your terms are, and just see if they're interested in actually going to contract. And sometimes they'll give up their financials just based on your letter of intent. If you craft that well, they'll figure you need the rest of the information in order to really formulate your contract.
Mm-hmm.
So.
And your advantage of doing a letter of interest originally is it saves you a ton of time. So if you can go ahead and squeak in there just with a good LOI, then that would be a faster, easier way for you to spread out some letter of intents across the board to anything that looks like it might be good, and then play back and forth with them on negotiations, getting the information, and only taking the time to put real offers together for those people, the couple that are willing to play ball with you and seem like they're okay in negotiations with you, because a lot of times you're not paying full price for these as an investor. Yes, they're usually investors as well. They know the game, but you still want to get it as cheap as you can to increase your profits. And so sometimes that means that you're going to throw out some LOIs that don't even get any interest, and that's okay. So I like that Steve brought up, go ahead and write up letters of interest on these properties that look like they might be possibilities, and then just go from there.
Yeah, that's spot on. And I also like you to recognize that that doesn't cost you any money to do that. You don't have to come up with any down payment money or earnest money, but you also don't have the deal sewed up. So even if they reply to your letter of interest and said, yeah, we really want to go to contract, you still don't have anything other than a nod. And until you actually put it under contract and put some earnest money down, anybody else can come in and scoop your deal. So if you get a reply back, you want to move on that fairly quickly, but just understand, you can, like Christine said, you can throw out a gazillion of these things and see what looks good, what comes back to you, and then go from there. And so you don't have to initially worry about scrambling for the money, but you're going to want to be able to jump that direction pretty quickly.
Yeah.
All right, week 3, we're going to talk about the differences between managing on your own and managing with a professional. And I think when you start talking about commercial properties, it becomes really kind of a no-brainer. There's a lot of things that need to go down with the management of a property. Here in this diagram here, you see there's a bunch of them spelled out. So keep in mind that all those bases have to get covered. If you've got lots of units, then you're going to be pretty busy if you're doing that all on your own. Some of the things that you're going to need to be looking at would be inspections and leases. And you need to figure out whether you're going to do all that stuff on your own, or you're going to do that using an attorney. There's a bunch of different kinds of inspections you need to be doing. There's the move-in inspection, periodic inspections during the year, the move-out inspection. You need to be able to screen tenants to find out who's going into your property, take the applications, go through any of those things, and then you're going to need to address some of the legal issues that are involved with that. So we wanted to give you some tools that you might be able to start looking at some of those things. If you're going to look at doing anything on your own rather than contract it out, then you may want to look at a couple of these websites here. So MrLandlord.com and TenantCloud.com are both places where you can get forms, have background checks done, both criminal as well as credit. So there's some pretty good resources with a lot of good information there that you might check into. Christine, any thoughts?
No, that's good. You covered it thoroughly.
So we want you to be able to find the landlord forms, and using those websites that we just showed you, here's kind of a list of some of the things you might be looking for, right? And then once you get these forms, even if you're going to farm it out to somebody, you want to be familiar with it. You want to know what's on those forms, what are people asking for, how are they going to screen your tenants if you hire it out. You want to know what the criteria is, and you may have your own criteria that you want to interpose. So just be aware of what some of the issues are so that you know what to be asking for and you know what's getting covered. Mm-hmm. So just be aware of that. And this is some of the things you might be looking for. Week 5, this is where we're going to talk about adding value, and you do that in a number of different ways. I mentioned this earlier. You can increase the income, you can lower the expenses, you can manage the taxes, and you can also make upgrades to the property. Doing the upgrades to the property are kind of a pathway to increasing the rent. So you don't always get all the bang out of the buck. When you do an improvement, it's going to show up as a more rentable property at a higher rate. and that's how you're going to get your money back out of that. And in week 6, we'll be talking about taxes and rentals. And so the 1031 exchange, we'll talk about how you get started with that, what the rules are, how to invest with an IRA, what some of the advantages of buying and selling with regular financing might be. And so these are the topics that we'll be wanting to run by you. If you're looking at investing with an IRA, or you have investors that could invest with their IRA, here's some resources for finding out how to work with a self-directed IRA, which is what you're pretty much going to need if you're going to do anything with real estate. You need to be able to direct where that goes. So these are some custodians here, Pensco Trust, ETC, that's Entrust Administration, Entrust Group. So there's like 5 different groups here that can give you some pretty good information about how to do this. And so do a little bit of your research, find out who you feel good about, and then you can either set your own up or you can direct your potential investors to move their funds out of where they might be now and into a place where they can be able to direct it. And so rather than borrowing out of their regular IRA at an interest rate, they may just want to just move things over. There's less restrictions and more flexibility with putting it into a self-directed IRA. Thoughts on that, Christine?
Nope. Very good.
All right. So we have some additional products and services that we offer, and we do group webinars and one-on-one appointments. We have daily accountability calls that help you to be able to sort out how did things go yesterday and what do you got planned for today. We have group coaching for businesses, and we also have contracts and scripts available to help you with your conversations with different people as you start to build your team, as you work with real estate agents, etc. It's good to know what to say to folks, and so we've got some resources for that available. In the real estate world, we have several different topics that you can be able to check into. We have 6-week series on each of these different topics here: wholesaling, rentals, fix and flip, seller financing, bank owned foreclosures, commercial, mobile home parks, and storage units. By the way, our success series presentation next week will be about the mobile home parks and storage units. So if you're interested in that, then tune in next week for that. We also do life coaching, personal development. We love to work with people on time management, money management, wealth building. Those 2 topics there go hand in hand with almost anything else you may want to do in life. So if you want to be a successful real estate investor, it's pretty helpful to have your time management under control, as well as your money management, right? So if those are issues that might hold up what you're doing in your other business, that might even prevent you from being very successful. And so you may want to look at that and see if there's something there that you may want to be able to implement into your information gathering to help you with your other strategies. Some big issues that come up for people that tend to be a bit debilitating and sometimes create crisis. Divorce is one of those, grief and loss, as well as dealing with addictions. And so we've got some help with each of those areas as well. Christine, do you want to address any of those?
A little bit. I just want people to understand that sometimes becoming an investor doesn't mean you have to have $50,000 sitting in the bank. I remember some of the deals that I did were very small, $1,000 down, $2,000 down. And if that's more than you have right now, just understand that some of this money management and wealth building, where we are keeping you accountable to get out of debt, put some money in savings, possibly just cut some of your expenses. We can do an overview of what your finances look like, obviously in private. You know, we keep it very confidential, and then we can look and see where is it that you could save up $1,000 or $2,000. So if a deal comes along that allows you to put it together with just a small amount of money, either an option fee or a down payment or whatever that chunk of money becomes, that's a possibility. No, it doesn't happen on every single deal, but if you are prepared, then when those deals show up, you can do them. So these things that Steve's mentioned, the time management, money management, things getting in the way, like life problems, life stresses, sure, we all have them. We all go through things, but if they're holding you back, I want to emphasize what he said about the holding back. If you know that you can tackle it, you know you've got it under control, and within a month or 2 months you're going to be out of it and be fine, great. Maybe you still want some support. And I know that not everybody understands what we do. We don't fix all of your problems for you, but we can give recommendations. We have a wealth of experience in several of these categories. There are a lot of things that we can, number one, share with you, so you've got enough information, you've got some additional support, and you've got accountability. We don't just tell you what to do, we expect you to do it as well, and then we help walk you through that. So all of these things can be intermingled in your life and in your business. So if you want to be a real estate investor and some of these things keep coming up and biting you on the hind end, know that that's what we're here for. And if you're in a different category where maybe you're not overcoming a huge divorce or a huge death in your family, something like that, but you just don't have the best habits, maybe you just need a little bit of that weekly accountability to get you on track and become more efficient and more effective in what you're already doing. Those are the kinds of things that we do. Back to you, Steve.
Awesome. Thank you. Okay. We also do some business development. We talk about the elements of getting your business started, entity creation and taxes, marketing and sales, employee versus contractor issues. Talk about scaling, which is making your business grow, and duplication. We talk about leadership and how to be able to groom leadership for expanding your business. And so it's also another section that that we work with to help people that are building businesses that may not be anything to do with real estate. So that's something else that you may want to explore. You can contact us through any one of these methods. There's quite a few opportunities here to get a hold of us. We have a Facebook page, and you can find us there under the Accelerated Real Estate Investor. Our website is iliveaccelerated.com. By phone, you can call us at 801-809-2764. And we also have, courtesy of Ty, who is our awesome and amazing IT guy, he's posted up a lot of videos on the YouTube channel that you can find under I Live Accelerated on the YouTube channel. And he's taken clips of the different webinars that we've done and kind of condensed some things down where he's got, you know, maybe somewhere around 2 minutes or so of video taken out of things, just so people can get a feel for what's in there. And you might be able to grasp from some of those things some of the ideas and get an idea of whether or not that's something you want to really check into or not. So go ahead and check those things out, and if there's anything we can do to help you, if there's any area in here that you'd like to explore with us, we would love to be able to work with you in any way we can. And so with that, Christine, I'm going to turn it over to you.
Okay. I was thinking this afternoon that I'd like to throw something out there. So we're not going to make it an official promotion or anything like that this month, but I was thinking how nice it is. Actually, the thought came to me after somebody sent me an email to look over, and the website she was looking at said that the company had a free trial. And I thought, you know, it's sometimes hard. These Monday night things are good for people to test out kind of our style and a little bit about what we know. But I'm going to offer to any of you in the next week, if you're live on Facebook or if you've tuned into this recording, we have a whole chunk of things that you get included in our monthly membership fee. It's a very low fee. I honestly don't remember if it's at $49 or $59 a month, but it's a very small fee. And included in that, you get one consultation for the month. So every month that you are a member on our iliveaccelerated.com website, you'll get that. So maybe every month we just go through your money management or we go through your time management. But for this week only, and I'm only going to throw it out verbally, for those of you that are actually taking the time to listen this week, you can have a free consultation anytime in the next week for a half an hour with either Steve or myself. So get a hold of us. The best way on that phone number is to text at 801-809-2764. Send a text message and say, I'd like a free consultation, and we will throw something at you of your choice. So you tell us what you need, we're going to throw you the time, and if that'll help you get a little squared around right now with whatever you're dealing with in your life, I'm happy to offer that. And Steve, since I didn't ask you ahead of time, if you don't want to do them, I will do them all. But I hope you don't mind I throw you out there too, that if you guys would like a little, if you do better with a male or a female coach, then you can choose either one of us, but we'll let you do that. Are you okay with that, Steve?
You are amazing, as always. Yeah, absolutely.
Okay, excellent. So we hope you guys have enjoyed it. Thank you so much, Steve, for walking us through all that information. I don't know if you guys realize how much information that is packed into 1 hour, but that is the huge meal deal. You've got everything in there, from where to find good properties, where to post them for sale, so marketing is covered, how to build your team, who you might need on the team, different financing options, how to analyze things. That's a lot of information, plus everything he just covered. So I appreciate that, Steve, and I hope that you guys take advantage of something that you learned here tonight and be super blessed by it. Thanks for coming. All right.
Thanks, guys.
Tyrell, are you on there? Do you have anything you want to throw in for people?
Yes, I'm here as well. I really like the idea that you threw out just a minute ago. Awesome. Good stuff. And yeah, like Steve said earlier, the YouTube channel is going to be a lot of that fun stuff that's just kind of broken up, give you a little taste of these guys, their style, how they can help you if you're looking for time-sensitive type stuff. I also want to suggest that we do have Instagram as well. It's another place. There's a lot of fun stuff going on there too. So the Instagram channel is I Live Accelerated, just the same as the YouTube channel. A lot of daily inspiration and little things. Just a lot of different stuff kind of going on there than you might see on the Facebook or YouTube. Trying to keep things a little mixed up. So that's also an option. And I think that is it for me. You guys were awesome. Thank you.
You're very welcome. And you just reminded me about the tips. That word reminded me that we have weekly tips and tricks. We have a free newsletter you guys can sign up for. And every Monday morning, you'll get a little something that blesses you like this. Just something real estate or time management related. We're going to be mixing those up every single week. So it'll be positive no matter what it is. It'll be excellent motivation or information for you, and all you have to do is go onto the website to sign up for that. Is there any other way that they can sign up for the tips and tricks weekly email?
Yes, there is. You can get a hold. Let's see. How should I say that? For the Facebook page, if you want a direct message there and just give an email address and give consent that you'd like to be subscribed, I can do that manually.
Mm-hmm.
So there is that option. If you don't want to, if you can't get to the website, if there's any reason that it just can't, something you can't do or can't get to it, whatever the case may be, yeah, you can message us here on Facebook, and I will see that. And like I said, you just need to leave an email address and a name, even just a first name, and I can do that. I can take care of that.
Excellent. Thank you, Ty. The one from this morning was just a little example of how one of my clients made nearly $100,000 on one of her commercial properties, and I outlined what we did. So you've got the basics, the little blueprint of possibly how to go out and do your own commercial deal. It was actually a mixed-use building. It was residential and business. So it didn't even have a huge zoning on it. It was partially residential, very familiar to all of you because you understand the housing market. People like houses, people live in houses. And then the other half of the property was, it was commercial, it was zoned business commercial. So that was a really nice deal. And if you want to read about that, get a hold of Ty and he can send you the one from this morning if you already missed it. And that's all I've got. Thanks everybody for coming. Have a super blessed week. We'll be back next Monday night, like Steve said, with the storage units and the mobile home parks. So if you're interested in how those work and getting more detail on them, come back and join us again then. Good night, everybody.
Awesome.
Thanks, guys.
Thank you.
Bye-bye.
Bye, Steve.